Hey traders, we are back. I'm Brianna Valesky here with Garrett Cook, Joel Elconin, and we have Dr. Mikhail Melnik on the line. He is a Bloomberg economist as well as an economics professor at Kennesaw State University. Dr. Melnik, thanks so much for joining us on this Friday morning.
Thank you for having me.
So, Professor, quite the week we've had here, eh? What's your take on these wonderful U.S. GDP numbers?
Well, you're absolutely right. We've had quite a lot of entertainment, not just this week, but also the previous week when the labor numbers came out. Basically, if you recall, back about 3 months ago or so, 4 months ago, at the end of last quarter, we had this conversation, and you were saying how the U.S. economy is going to slow down sharply. And I was sort of agreeing with you and saying that it would slow down, but avoid going negative.
Yep.
Because there were some fundamental positive factors, right?
I do remember.
And basically that's what happened, right? Perhaps you were a little bit more correct than I was, because my expectation was that the slowdown, and I think I mentioned it on your show, I said that the slowdown was expected to go from November to February, and you were a bit more pessimistic. And in that sense you were right, because it seems like it extended all the way into March. Going to the GDP numbers, and that is actually a very interesting release. It's sort of mixed but negative. First of all, it came out below the consensus estimates. And that generally is not a very comforting feeling, especially given the fact that the Fed had to keep lowering its forecast for the U.S. economy throughout the quarter. So generally there was sort of, it was understood that there will be a pullback in growth. The question was how much, right? And the consensus, I think, was pointing to 1%, but we ended up seeing 0.2%. But I think there's a little bit of a mixed picture. Let me kind of go into minor details here. First of all, there is one tiny positive thing in the GDP numbers, and that is that about almost negative 0.2% was caused by the public sector. So in other words, the public sector did not contribute to an expanding economy, but rather caused a minor contraction. It was mainly done by the state and local governments, but nonetheless there was a minor contraction by the public sector. That means that if you examine just the private sector, the growth is slightly higher. Instead of being 0.2%, it's 0.4%. So a bit closer to the consensus. So that's a positive thing. But that's about the only positive thing. And that's where I'm a bit worried, and maybe the outlook is not as nice going forward, especially into the second quarter. If you look at the numbers closely, you'll notice this is not the repeat of the first quarter of last year. Consumption spending actually held, and so there we had a relatively minor pullback. But it's the business spending that's really problematic this time. If you look at the investment component of the GDP, that one contracted and caused an overall contraction in the economy. But not an overall contraction, but reduced the growth rate. But the problem is where that contraction came from. Non-residential investment contributed almost negative 0.5% to the GDP growth in real terms in the first quarter. Now, that's a little bit problematic because we need that investment in order to create jobs, in order to expand our economy. So that key component in terms of the level of economic activity in the labor market actually contracted. And what makes it even worse is that, by the way, this is the first contraction since the first quarter of 2009. So in order for you to see a contraction going back in history, a contraction in the non-residential investment in the U.S., you got to go all the way to the recession that started all this mess. And also an alarming development for the labor market is that the non-residential investment contracted, and by itself caused a negative 0.75% growth in that's its contribution to the GDP growth. This one also hasn't been seen since the first quarter of 2013. Now, why is non-residential investment? Why is non-residential structures investment? Because this is now structures investment. Why is that important? Well, this one is strongly correlated with the future labor market activities. So that points out to a sort of softer labor market growth this year, which again we sort of expected.
Mm-hmm.
So it doesn't mean that the labor market is going to contract. We're not seeing layoffs. That's why the initial unemployment claims numbers seem to be improving. We reached a relatively low level of about 260. Just that was released yesterday, so for the past week. And so we're not seeing layoffs, but we're not seeing the likelihood we're going to see significant job growth is relatively low. Perhaps March was an outlier, but returning back above 200 as a stable rate is unlikely until this non-residential structured investment issue is resolved. So, and then, of course, another minor point that's also seen in this GDP, and you've seen it played out in the news rather nicely, the foreign sector contribution is significantly negative this time. We're seeing a negative contribution from exports. There's a decline in exports, and there's a rise in imports. And that's despite the fact that commodity prices are relatively low, and we're still buying a little bit of oil from overseas, right, so to speak. So basically, that means that the effect of the dollar is starting to translate not only on corporate earnings, but on the GDP equation itself. And I think all of this sort of is consistent with the argument you and I played back and forth since October, which is basically the Fed is unlikely to act this year. The likelihood that the Fed will raise rates is relatively low because of the economic data we're seeing. And I think there is a little bit of a miscommunication, it seems to me, between the market and the Fed, because the Fed keeps saying that watch the economic data. The policy is influenced by the current economic events, whereas the market seems to try to pinpoint the exact date and aim at that. So, but that's basically how the GDP looks like. So, in my opinion, this is a mixed picture, but it's not a positive one, and it also creates a little bit of a problem. This pullback in there's one other problem in the GDP, by the way.
Well, I wanted to ask you before we get into it.
Ahead.
What's your take on the dynamics of the import numbers compared with the export numbers? Because when I look from Q4 to Q1, and I'm looking last year just on imports, goods and services, they had a nice uptick in their GDP contribution, or at least their percent change from the quarter prior. But this time around, we had the exports drawn really heavy, which is obviously most likely because of the USD. But what do you make of the strength in imports relative to exports this time around?
Well, I mean, that's expected, right? Because overseas we don't have a very strong economy,
no.
Right? If you look at the dynamics of our own of imports into the United States economy, right? They're a function of the United States dollar. They're a function of our own consumer behavior, but they're also a function of how soft the economy overseas is, right? As the economy overseas softens, it sort of causes more foreign firms to orient towards what seems to be the most robust market on the planet, right? Mm-hmm. And at that point in time, or now, it's the United States. So, so that dynamic is relatively expected, right? I think what I wanted to mention also about the GDP, which I think is an interesting point, if you look at the data from from the last quarter, you'll notice that business inventories went up. So not only did we have a reduction in the overall investment spending and non-residential investment, but within that, the inventory component went up. So if you look at the last year's first quarter, you would notice that we were actually depleting business inventories. And that's what helped us re-jump the economy in the second quarter of last year. So that's why the big negative growth in the beginning of 2014 did not translate into soft growth later on in the year, but actually translated into a jump. So there was significant volatility in business inventories, which made it difficult to predict the GDP numbers, by the way. But this time around, there isn't that much volatility. In fact, we've seen accumulation of business inventories and in the first quarter, and that also translates into a softer growth going forward. So, but going back to the international issue, I think that economies overseas, although are finding a little bit of traction, the traction is not that much. And you can look at the trade balance if you want to draw parallels. One easy scenario is to go back to the 1990s, late 1990s, when the Asian financial crisis took place. That one had an interesting effect on the U.S. economy. It caused a pullback in price, in the level of prices, in part because the Asian economies affected by the crisis were trying to sell their goods in the United States. And that led to a jump in imports and at the same time lower prices. So that sort of underscores how important it is, how important the U.S. market is relative to the rest of the world. Now, a few things have changed since 1997, but fundamentally we're still in that environment. So it's still the U.S. plus something else that makes up the global economy, not the global economy plus a little bit of the U.S. So the U.S. is still the largest component.
All right, excellent. And now, since we were talking about international economies, what's your take on Russia? I mean, they cut their rate this week. I think it's their weekly repo rate from 13.5% to 12%. Remember this thing? I think it went from 7 to 17 in January.
Love it. I love the fact that they're cutting their rate. In fact, if you recall, they started doing that shortly after they said they stabilized the ruble, right? Mm-hmm. If you remember, going back into our November discussion, I was against any rate increases in Russia, right? And so I believe that the last thing you want to do is, Russia is in a very difficult situation right now, economically speaking, and that's because of the price of oil. But now that we're seeing the price of oil, the WTI reaching $60, so we're back to that number, which is again,
their deficit.
That's a nice sort of stable range. I remember being interviewed by you guys back in December, not on your show, but in one of your articles, when it comes to the price of oil. And at that time, the price of oil was in a free fall, and many were forecasting that it would decline further. And I said, no, we'll find traction in the low 60s. Because that's where the marginal cost of production for a lot of the producers who entered the market within the last 5-6 years is. So it's in the upper 50s to roughly $60 range. So, and that's what's happening. We're starting to find that traction as we approach $60. And don't forget that the Brent is priced slightly higher. So this gives Russia a little bit of a respite and allows the ruble to stabilize in a more or less reasonable range. But the last thing I think Russia should do is, see, the problem with Russia is very complex. On the one hand, there is a very strong headwind coming from the price of oil. The price of oil is still considerably lower than what the Russian government considered at the very end of last year, ironically, or in November of last year, in terms of its outlook for this year. So that creates a significant budgetary issue in Russia, since the budget of the central government and many regional governments, mind you, is based on the price of oil in many ways, or is influenced by it. So if you look at that headwind, it's pretty strong. But at the same time, that caused the ruble to almost take a free fall, in essence. And the Central Bank of Russia decided to focus on the ruble rather than the economy in the short run and try to stabilize the currency. And that's understandable, although personally I would have probably done it differently, but that's understandable. You need to stabilize the currency in order to have stable terms of trade, in order to reduce inflationary pressure in the country that affects especially people on fixed income. So they focused on that. Now that the price of oil is providing a little bit of a relief, it makes no sense to keep the rates high and keep choking the domestic economy. Now, in terms of Russia, it's actually very interesting. If you were to ask me what would be a sign for the Fed to raise rates in the United States, right? In other words, what would cause the Fed definitely to begin to raise short-term rates? And that would be a significant shift in inflation expectations that would probably come from a rapidly depreciating U.S. dollar. In other words, the Fed would definitely have to act if the dollar were to take a significant dive. Now, is that possible? Well, for that, there has to be a competitor to the dollar. And if you look around the world, there isn't one, right? The Eurozone, the euro currency, is the largest other currency on the planet, but that one is backed up by a collection of economies that have enormous and exciting issues. And if what we see in the news is true, and there will be a deal worked out with Greece, and Greece will stay in the euro, well, I think, that only softens the euro in the long run or in the medium run, because it will encourage other countries to essentially follow the path of Greece, and at the same time, and by the way, that might not be a bad idea for the eurozone economies. They may not want to see a strong euro, and that's what you see that's what you see in the monetary policy of the European Union. But my point is that there are no real competitors. The ruble, ironically, which seems to be very soft today, potentially is the most interesting currency out there, because it's backed up by enormous natural resources of the country. And don't forget, the Russian economy is not just a major exporter of oil and natural gas. It's also a significant player in the commodities market, broadly defined, including agricultural commodities, where the outlook is probably getting only better and not worse. So, and the Russian economy is trying to reorient itself. So they're taking rather interesting and, in some sense, fundamental steps in that direction. So hopefully that will work within a couple of years. It takes time to reorient a major economy with 140 plus million people like the Russian economy is.
All right, awesome.
But I think that, but I also think that there are some interesting political issues that derail the advancement of the ruble, one of which is what's happening in Ukraine. So, we can't separate economics from politics.
All right.
And the political developments are driving a wedge between the European Union and Russia, and that actually has a negative effect on the Russian economy.
Okay.
And on the European economy as well.
All right, thank you, Professor. We got to wrap it up. We're up against the wall here. So thank you, Dr. Mikhail Melnik, Bloomberg economist and professor at Southern Polytech State University. Thank you, sir. We appreciate having you on.